Silver hit $120 an ounce in January. It is sitting at $70 today, and the financial media has decided that both of those facts tell the same story, that the silver bull run is over, that Kevin Warsh is going to keep rates high, that the dollar is strong, that you missed it. Every single one of those conclusions is built on an incomplete analysis of what has actually happened over the last 55 days, because in those 55 days, two separate earthquakes hit the silver market simultaneously, the Federal Reserve froze its rate path, and Kevin Warsh was nominated to replace Jerome Powell as Fed chair. Markets panicked on both. Silver crashed 39% in a single session after the Warsh announcement, the worst day for silver since March 1980. And now, 53 days later, silver has recovered from those lows and is consolidating right around $70. What I am going to show you today using data that has been published in the last 72 hours is why this $70 price is not the end of a story, it is the middle of one, and why the specific combination of forces now locked in place by the dot plot, the Warsh nomination, the Strait of Hormuz, and the April CPI print coming, in 3 weeks is producing a setup that serious silver investors have not seen since 2020. Let me start with what actually happened at the March 18th Fed meeting, because the mainstream coverage got the headline right and missed the substance entirely. The Federal Open Market Committee voted 11-1 to hold the federal funds rate at 3.5% to 3.75%. That was universally expected. Not one professional economist predicted a change. The only dissent came from Governor Stephen Miran, who voted to cut. What moved markets was the internal distribution of the dot plot. The chart showing where each of the 19 Fed members thinks rates should be at year's end. Here is the number that nobody reported correctly. The median dot is unchanged, one cut in 2026, same as December. But here is what Powell himself said in his press conference, and I am going to quote him exactly. If you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. 4 or 5 people went from 2 cuts to 1 cut. That sentence is everything. The median held at 1 cut, but 7 members now project 0 cuts for the entire year. 7. A near majority of the Fed is looking at oil above $100, at a Strait of Hormuz that the IEA's executive director called the greatest global energy security challenge in history, worse than both 1,970 seconds. Oil shocks combined, and they are saying, we cannot cut, not April, not June, maybe not at all. The Fed also revised its PCE inflation forecast up to 2.7% for 2026, up from 2.5% in December, and that forecast was built before oil ever crossed $100 a barrel, before Brent briefly touched $112 last Friday, before Goldman Sachs revised their oil estimates to $110 average for Brent through April. Now let me show you why that matters for silver, and I need to do this carefully because the mainstream analysis of the Warsh nomination, which is still dominating every financial headline, is actively pointing you in the wrong direction. On January 30th, when Kevin Warsh was announced as Trump's nominee to replace Powell, silver had a day that financial historians will study for decades. From intraday highs above $120, silver futures plunged 39% before recovering, hedge funds were margin called, levered paper positions were liquidated in a spiral. It was the kind of move that happens when forced selling overwhelms fundamentals, not when fundamentals change. Let me tell you what did not change on January 30th. The global silver supply deficit did not change. That deficit has now run for 5 consecutive years, with the market gap expected to remain large through all of 2026. The COMEX registered inventory did not change. It remains at historic lows, more than 70% below its 2020 peak, according to Citigroup research published in January. China's silver export ban enacted January 1st and now permanent did not change. The Strait of Hormuz did not change. The inflation math did not change. What changed was sentiment, levered paper positions, speculative bets that needed to be unwound. That is not a fundamental change. That is a clearance sale, and the clearance sale has been running for 55 days. Now I need to be honest with you about Kevin Warsh, because the Warsh is a hawk. Warsh will destroy silver narrative that has dominated coverage since January 30th is based on a version of Warsh that is 15 years old. Yes, Warsh resigned from the Fed in 2011 in protest of aggressive monetary expansion. Yes, he has called for normalizing rates, but read what analysts have actually said about the nomination in the weeks since. Macquarie Group strategist Thierry Wisman wrote that Warsh has shadowed Trump on monetary policy almost every step of the way since 2009, and that while it doesn't mean immediate cuts, it could indicate he would be quicker to ease when conditions call for it. The market initially priced Warsh as a 2011 era hawk. The market may have been wrong, and the market is already beginning to figure that out, which is why silver has recovered from its January lows. But the full repricing has not happened yet, because the Senate confirmation is still pending, because Powell is still technically in the chair, because the uncertainty itself is not fully resolved. Here is the piece of the Warsh story that nobody has connected. His most controversial view is not actually about interest rates. It is about the Fed's balance sheet. Warsh wants to shrink it aggressively. The Fed's balance sheet currently stands at $6.65 trillion, down $2.4 trillion from its 2022 peak, but still historically elevated. If Warsh accelerates balance sheet reduction, that is a tightening of financial conditions through a different channel than rate hikes. It does not require raising the Fed funds rate, it does not fix the Hormuz problem, and it does not stop the real rate from going negative as oil-driven inflation rebuilds. Now let me do the math. Simple math, you can check yourself, because the real interest rate is the only number that actually matters for silver long term. The current federal funds rate, 3.625%, the midpoint of the 3.5% to 3.75% range. The February CPI, 2.4%, real rate today, 3.625 minus 2.4, equals positive 1.22%, technically positive, technically dollar supportive, technically silver negative. That is what CNBC is telling you. Here is what they are not telling you. That 2.4% February CPI number is a pre-war figure. The Strait of Hormuz closed on March 4th. The oil shock showed up in energy prices after that data was collected. The Dallas Federal Reserve published research on March 20th 5 days ago projecting that a full quarter of Hormuz closure raises WTI prices to $98 per barrel and lowers global GDP by an annualized 2.9 percentage points. That GDP hit, if it materializes, will run directly into a Fed that the dot plot has locked in place. Goldman Sachs revised their Brent crude forecast to an average of $110 in March and April. The Chevron CEO, speaking at the CERAWeek conference in Houston on Monday of this week, said the oil futures market has not fully priced in the scale of the Hormuz disruption. His exact words, "There are very real physical manifestations of the closure of the Strait of Hormuz that are working their way around the world through the system that I don't think are fully priced into the futures curves on oil." That is the CEO of the second largest oil company in America saying the oil price has not yet finished rising, and every dollar that oil rises adds approximately 0.4% to CPI within 90 days. Oil has gone from $70 to a peak above $110, a $40 increase, 40 times 0.4, 16% of additional CPI pressure. Building in the pipeline right now, the February CPI of 2.4% was collected before a single barrel of that mattered. Now redo the real rate calculation for May. Nominal rate, 3.625%. CPI in May, potentially 3.5% to 4.5% depending on how long Hormuz stays disrupted. Real rate, 3.625 minus 4.0 equals negative 0.375%, a negative real rate. And remember the dot plot that was just confirmed on March 18th. Locks the nominal rate in place. The Fed cannot quickly pivot without causing the exact volatility it is trying to prevent. Now I want to address something directly because you have seen the headlines. On Monday, Trump announced very good and productive conversations with Iran. He ordered a 5-day pause on strikes against Iranian power plants. Oil fell 10% on that news. Brent briefly touched $99 from $112. Silver was volatile. Here is what you need to understand about that ceasefire signal. First, oil is still at $100 even after a 10% drop on ceasefire optimism. Second, Hormuz remains effectively closed today. Flows through the strait are at 5% of their normal volume according to IEA and vessel tracking data. Third, even if a deal is reached, Chevron's CEO said it will take time to rebuild inventories and repair damaged infrastructure. QatarEnergy's CEO told Reuters an Iranian missile strike on Qatar's LNG infrastructure could take 3 to 5 years to fully repair. The energy shock does not end the day diplomacy is announced. It ends when tankers start moving again at full capacity, when production comes back online, and when storage is rebuilt. That timeline is measured in months, not days. The Warsh market and the geopolitical market are telling two opposite stories right now. Warsh says tighter, stronger dollar, silver down. Hormuz says inflation, stagflation, real rates negative, silver up. This is the tug of war the original script mentioned, and now it has a new dimension with the ceasefire talks adding a third variable. Let me show you the precise historical comparison that makes this moment readable not as speculation but as pattern recognition. The year is 1979, Iranian Revolution, oil supply shock, supply-side inflation the Fed's tools could not cure. The Fed at the time was seen as behind the curve, trapped between a slowing economy and accelerating prices. Sound familiar? In that environment, Paul Volcker eventually raised rates to 20%, and silver still rose 700% over 12 months because the inflation was not demand pull. It was supply side. Rate hikes could not open the Persian Gulf. They could not restart Iranian oil production. The inflation persisted regardless, and the real rate turned negative regardless because you cannot raise nominal rates fast enough to outrun supply-driven inflation when your economy cannot absorb the hikes. Here is the critical difference between 1979 and today that makes today's setup arguably more favorable for silver, not less. In 1979, the Fed was raising rates. Today's dot plot has locked the Fed in place. No hikes, maybe one cut. But with oil at 100 plus, the real rate is turning negative without the Fed moving at all. The inflation is doing the work. The dot plot is just holding the door open. Now let me give you the domino sequence that is currently in motion, updated with everything that has happened in the last 6 days. Domino 1, the dot plot freeze. 7 Fed members now see 0 cuts in 2026. The median is 1 cut, probably in December. The inflation forecast was revised up to 2.7% PCE, but that was pre-Hormuz oil spike. The real inflation trajectory is running above the Fed's own published forecast, and the Fed cannot course correct through a dot plot update until June at the earliest. Domino 2, the April CPI print. April CPI data, which prints in mid-April, approximately 3 weeks from today, will begin to capture the energy shock. March prices, when oil was surging above $100 a barrel and gas prices were rising nationally, will show up for the first time. Every analyst consensus expects a meaningful upward surprise relative to the Fed's published PCE forecast of 2.7%. This is not speculation. The math is already locked in. Domino 3, the Warsh transition. Powell's term ends May 15th, that is 51 days from today. During those 51 days, two chairs are effectively running the Fed simultaneously, Powell conducting policy, Warsh signaling the direction of future policy. The transition itself creates uncertainty and uncertainty in a market where silver has already corrected 40% from its highs, resolves through volatility, not through calm. There is a scenario, and it is not the base case, but it is a real scenario where Warsh's first signal as incoming chair is more dovish than the market has priced. He has been supportive of rate cuts in some public statements. He has criticized the Fed for being too slow to cut. If his first testimony signals accommodation for a slowing economy rather than pure inflation fighting, the repricing of precious metals will be immediate and substantial. Domino 4. The Global Positioning. Bank of America's metals research head Michael Widmer has published a 2026 scenario range for silver of $135 to $309 per ounce, derived from historical gold to silver ratio compression. The $135 level reflects the 2011 ratio low of 32:1 applied to current gold prices. The $309 level is based on the 1980 Hunt Brothers ratio of 14:1. These are not base cases, they are scenarios, but they are published by one of the largest financial institutions in the world. Reuters polled analysts and arrived at a 2026 average price forecast of $79.5 per ounce. JP Morgan's global research team set their 2026 annual average at $81 per ounce. Silver is at $70 today. Let me pause on that for a moment. Consensus forecasts from major banks call for $79 to $81 silver as an average for the full year. The current spot price is $70. If those forecasts are correct, silver simply has to return to its consensus average to produce a 15% gain from here. That is the conservative case. The bull case, negative real rates, Warsh pivot, Hormuz prolonged, looks very different. What does the Trump-Iran ceasefire signal mean for silver? Here is the framework. If the ceasefire holds and Hormuz reopens, inflation blunts, oil retreats, and real rates stay positive, silver's near-term upside is capped, but the floor remains firm at $65 to $85 because structural supply deficits and Warsh uncertainty remain. If talks fail and Hormuz flows are currently at just 5% of normal, the upcoming April and May CPI prints will capture the supply chain oil shock. Real rates will go deeply negative, the Fed will be trapped, and silver's breakout won't be gradual. The asymmetry here is massive. The downside scenario is already priced into silver's $50 correction. The upside scenario, Hormuz disrupted, negative real rates, a dovish Warsh pivot, isn't priced in at all. You are buying volatility on the cheap. Look at the divergence between the physical and paper markets. COMEX registered inventories are down 70% since 2020. Spot silver is in backwardation, meaning buyers are actively paying premiums for immediate delivery. When the paper price crashed 39% in January due to forced liquidations, physical premiums actually expanded because dealers couldn't source metal at depressed paper prices. That genuine physical tightness is the most important tell in the market. Let's simplify where we stand on March 25th. The Fed just locked rates in place until June, relying on a stale 2.4% CPI while ignoring an unprecedented energy crisis. Kevin Warsh takes over in 51 days, bringing unresolved policy uncertainty to a market that just corrected 40%. The oil shock persists. Crude is firmly at $100 despite a record for 0.00 million barrel strategic reserve release, and Chevron's CEO warns the futures market hasn't fully priced in the Hormuz closure. The supply deficit enters its sixth year as China bans exports and industrial AI or EV demand skyrockets. Silver sits at $70 today, down from $120. The correction happened for real reasons: the Warsh nomination, forced margin liquidations, and ceasefire optimism. But the core fundamentals driving it to $120 haven't changed. The real rate math is actually more compelling now. Only the price has changed. The best time to position is when price corrects on sentiment while fundamentals remain intact. The mainstream media is writing headlines based on a screen. You now have the actual math. Between now and Warsh's May 15th takeover, the April CPI print, the Senate confirmation, and the oil market will serve as explosive catalysts. All of them are hitting a silver market sitting $50 below its high with a massive supply deficit underneath it. Stay close. This story is moving faster than almost anyone is positioned for, and I will be here with the data at every step.